My name's Francois. We're Hedgehog. We are crowdsourced risk solutions for the retail investor. So what does that mean? It means that we stop terrible things from happening to good investors, right? On Black Monday in 1987, in one day, 22% of the value of the stock market evaporated. In 2008, 97% of supposedly de-risked mutual fund product lost money. And the mean loss was almost 40%. In 2010, on May 6th at 2:45 p.m., the stock market lost almost 10% of its value in 36 minutes. This is a big problem for the financial services industry, because we're not going to be able to sell mutual funds to the next generation of investor. There's a solution to mitigate risk. It's called a hedge. 50% of US households are invested in the stock market. 9 out of 10 of them don't know they're exposed to this level of risk, and 9 out of 10 of them don't have a plan to mitigate that level of risk. So what are they going to do? The first thing they're going to do is Google it. And what they're going to learn is that the portfolio theories have flaws. By portfolio theories, I mean the models that your robo-advisor or your wealth manager are using to give you advice. But what they're also going to learn is that there's no easy solution to find out what your risk is. 13 times over the last 30 years, actual market performance has broken all the risk models. And what people are worried about are the black swans. Those events that were supposed to happen maybe once in a lifetime, but are happening with more and more frequency and less warning. So the markets behave like this on the right. They don't behave like the models on the left. And we're all the way at the top on the far right, which is the perfect opportunity for a hedge. So how do we solve this? First thing we do, we use big data to do two things: to profile investor risk and underwrite and analyze alternative assets that aren't linked to the securities and fixed income markets. We use artificial intelligence to model how markets actually work. And we crowdsource human intelligence to find the answers. We put it all in a blockchain to scale and verify data quickly. So what does it look like? What we do is we give the next generation investor the tools they're used to interacting with. So it's a search bar, but it's contextual. When it says, I want to hedge the mortgage market, it knows that what you're worried about is commercial mortgage-backed securities, which caused the last crash. It then takes all the data about the investor, their portfolio, their transactions, their assets, their liabilities, puts them all in a risk engine. What comes out the other side is recommendations, but contextual recommendations that fit actual market conditions. And if you like, on the platform, it'll refer you to a wealth manager. What this means for community banks is that they'll be able to scale their wealth management and private banking advisory services. Instead of talking to 1,000 clients a day, maybe they're talking to 10,000. And what comes out the other side of the risk engine is not only all the information about the investor, but what they're actually concerned about. So it saves a bunch of time. So if this sounds familiar, this is how hedge fund analysts got out ahead of the last crash. So this is a rather large market. $9 trillion today is held by investors who are unhedged. The data, news, and analysis portion of that is about a $26 billion market. Just the data analytics segment is $12 billion and growing at 60% CAGRs a year. That's a $200 million opportunity for us at 0.1% market share. So why now? First thing, the data, the institutional level data is finally becoming available. And the technology is not only available, but getting traction through the business models, and people are adopting them. And finally, the next generation investor is going to control $50 trillion in wealth in the next 20 years. So the competition in this space, how we measure it is by asset diversification and allocations. The more and different types of assets you can invest in, the greater the opportunity to manage your risk. And then transparency. How much understanding and insight can we give the investor into the risks they're taking, the positions they're taking? There's some institutional players in this space, Charles Schwab Intelligence, Wells Fargo. Interestingly, Wells Fargo invested in a consumer-facing engine, iMatchative, it's right next to it. Some disruptors, Betterment and Wealthfront. Forward Lane is up there. They're Techstars play in this space. And Union Square Ventures. I included them because they're the shadow bank. What they did was get a couple of their portfolio companies together and start working on what they called Robo-Advisor 2.0. So we're a business to consumer. We think of us as an easy button for your risk or a Google search bar for your risk. We integrate everywhere across anyone's platform through a white label, and we convert a lot of our potential customers into clients. One important thing about this business model is we don't disintermediate. So here's our team. Ijama is a capital markets entrepreneur with a successful exit. Spencer has got expertise in marketing to the crypto markets. And Albert has been building risk engines for the global banks. My name is Francois. As Bob said, I'm a FinTech entrepreneur. I built this because I needed it. Today, we're a server in a closet. If we were just to remain that, it's still a $20 million revenue opportunity by year 5, so this is how you get your money back. And we're early. We started just before we got to VC FinTech. We're launching our beta in September, and we're raising our seed round in August. Happy hedging.